Hi guys, today's topic, Uber versus Lyft. Which stock is a better buy? Only 7 or 8 months ago, these two took the market by storm. Both were very highly anticipated and very much hyped initial public offerings, which came out in the middle of 2018 with Lyft's IPO market cap projected to reach 28 billion to 30 billion in valuation, and Uber's IPO market cap to reach 100 billion in valuation, with some Wall Street commentators and participants projecting Uber's valuation to be as high as 120 billion. I tell you guys, the excitement was so high that a lot of hedge fund and private equity managers started to sell their other long-term stock market positions in order to get in on these IPOs, causing declines for Dow and S&P 500 in March of 2019, which was pre-IPO time for Lyft, and in May of 2019, which was pre-IPO time for Uber. Wow! Lyft came out with IPO price of $72, and after a couple of days of trading in the range of $70 to $80, quickly started to descend and made its low of about $37 back in October of 2019, which was essentially 50% lower than their original IPO price. Uber's IPO was not much better. Following their initial public offering, Uber's shares dropped 11%, resulting in the biggest first-day dollar loss in IPO history for the US. And it didn't stop until it reached its low of about $25.50 back in November of 2019. It turned out that the investors were not that dumb. How about that? And they pretty much immediately saw through all this hype that these companies are financially struggling, and hyped up the valuation is just a myth created by Wall Street bankers and underwriters in order to make money on these IPOs. But recently, both of these companies are making news, with Morgan Stanley analysts calling Uber stock his top internet stock pick for 2020, and Lyft partnering with LeBron James to create a bike share program. So which stock is a better buy right now? And if I had $100, how would I invest it between these two stocks? Before we continue, guys, please take a second to subscribe to my channel and smash that like button below, as more cool and exciting videos are coming up on this channel. So let's dive in. Uber is the larger company with approximately 69% overall global market share in ride-sharing business, and Lyft holding about 35 to 40% of the US and Canada market share. Being a smaller company has its own advantages and disadvantages, because Lyft is more of a pure play, concentrating only in US and Canada. Imagine a chessboard and you're one of the players and you're trying to attack your opponent on all sides at the same time, on the left side, on the right side, or at the center, which means your pieces are all over the board and not concentrated in one place to launch a legitimate offense. Meantime, your opponent is only attacking on the right side with all his pieces concentrated only on the right side. So who do you think will have a better outcome? I mean, it's not that simple as a chess game, of course, but you get the picture. That's why Lyft's ride-sharing market share in the US and Canada grew from 12% back in 2012 to 35 to 40% in 2019. I mean, Uber has other businesses besides ride-sharing, such as Uber Eats or Uber Freights, and guess what? Those businesses are losing money hand over fist. But recently, Uber and their CEO, Dara Khosrowshahi, I think I just pronounced his name. Anyway, Uber's management team has changed their tactics by offloading whole or portions of their slow growth or unprofitable businesses to local competitors for a stake in competitors' business. They just did it recently with their Uber Eats business in India by offloading it to Indian company Zomato for 10% stake in their business. Pretty smart decision if you ask me. Instead of fighting local competitors on their turf by undercutting each other's prices, just join them. So your former competitor has become your partner, and now them, not you, has to deal with all the headaches of running the business, and you just get 10% while doing other things. In fact, just recently, Dara said, if we can't get to number one or number two, we aren't going to make money for our shareholders, and we're going to do something about it. So if Uber can offload their unprofitable, money-losing businesses to local competitors while focusing on their growth portion of business, that can really bring the company closer to profitability. Wow, that's a great model. Wall Street applauded their sale to Zomato by sending shares of Uber higher by 8% that day. By the way, Lyft also wanted to dive into food delivery business and actually tried to do it in collaboration with Taco Bell back in 2014, but quickly abandoned those plans in favor of just focusing on ride-sharing business. In terms of financials, Lyft does have a pretty good balance sheet. They have a total cash of $3.12 billion and only $448 million in debt. So their debt to equity ratio is very healthy, with book value per share of around $10. And can certainly withstand the war with Uber on prices, and Uber knows that. Uber is no slouch itself, having $12.6 billion in cash and total debt of $7.5 billion, which is also pretty healthy. Notice that Uber's book value is actually smaller than Lyft's book value. So both companies are financially healthy, both growing at about 30% per year, but still bleeding money. What's the path to profitability? Well, the good news is that market is pretty much a two-horse race. It would be very difficult for anyone new to enter this market and compete with these two, because they're just too much ahead of the game, and a new player would require an enormous amount of cash and effort to shake their positions. What it means? It means that instead of undercutting each other on price, fighting for market share, they can just raise their prices, and that should bring them closer to profitability almost immediately. What a novel idea. Also, the demand from drivers seems to be very high, so I know the drivers don't want to hear this. Drivers, please close your ears. But the company can cut into driver's share a bit more. So, for example, instead of taking 20 cents on the dollar from the driver, they can take 22 or 23 cents on the dollar from the driver. Another good news is autonomous driving. Both companies are drooling over an opportunity to introduce autonomous driving. Why? This is another news that the drivers don't want to hear. Drivers, close your ears again. It's very simple. If you don't have to pay drivers, that brings your costs down significantly. Autonomous cars should also lower insurance expense and eliminate driver discounts. Lyft is already experimenting picking up drivers with Waymo, that's Google driverless cars in Las Vegas and Phoenix. Uber, on the other hand, was having a huge success with their self-driving car service in Pittsburgh, until back in March of 2018, their self-driving car has killed a pedestrian who was crossing the road at the wrong place. Uber immediately pulled all of their cars off the roads and spent months handling legal issues associated with the accident and fixing their software. So autonomous driving is not quite prime time ready yet. But it's coming. Sooner or later, the autonomous driving cars will be on the road, and that's good news for Uber and Lyft. Besides that, electric bikes and scooters is the latest hot area where both companies experience tremendous growth lately, especially on or near college campuses. Lyft also contracts local businesses to use their ride-sharing service, and both Lyft and Uber can buy cars and rent it back to drivers. Since Lyft is currently limited to US and Canada, it has less runway for growth than Uber. Lyft can address this through acquisitions overseas or entering new markets. The corporate rider initiatives are working well, and ride-sharing could help too. Lyft has substantial cash and a valuable stock that can be used for acquisitions. Uber has even a bigger runway for growth, especially if they execute their recent strategy of exiting low growth and less profitable markets by becoming partners with the local competitors. But they both need to get their marketing and administrative and other costs under control, especially considering that both of them are well-established companies and there is no need to promote their services as much. There are some regulatory risks, of course, more so with Uber because they are in a lot more markets than Lyft. The recent challenges came from California, where they have adopted a new law called AB5, which defines what an independent contractor is. In simple terms, it will require many Uber and Lyft drivers to become full-time employees. This law will be challenged in the next election, November 2020. Frankly, I think that most drivers do want to stay independent because majority of people driving Uber or Lyft are not full-time drivers and they like to work at their own schedule, and many of them drive less than 20 hours a week. As to valuation, Lyft expects to be adjusted EBITDA profitable by the fourth quarter of 2021. For those of you unfamiliar with EBITDA is, it is earnings before interest, taxes, depreciation, and amortization. It is unclear when Uber is supposed to become profitable. Both of them are growing at approximately 30% per year, but Uber has some high growth but money-losing businesses such as Uber Eats and Uber Freights. So if, and that's a big if, Uber gets those two puppies under control, they should achieve profitability in the next 2 to 3 years. So, bottom line, with today's respective market caps for Uber at 62.7 billion and for Lyft at 14.4 billion, and if I had $100 and needed to invest in these two stocks, how would I invest it? I would put $60 in Uber and $40 in Lyft. Because despite Uber's financial struggles, they are a better growth company than Lyft. If Dara and Uber's management team can figure out a way to put this company on the profitability path, then it could be a little bit better investment than Lyft. But don't discount Lyft completely. They are here to stay, just like Uber. That's my take on this, guys. Don't forget to subscribe to my channel and smash that like button. And please leave me comments and tell me what you think. And I'll see you next time.